The Bank of Canada raised its key interest rate to 5% yesterday. That's the 10th rate hike in 18 months. They've now gone from virtually 0 to 5%, the highest level in 22 years. And it's putting the pressure on Canadians who already face a high cost of living.
We are acutely aware that this is a very difficult period for some Canadians, and interest rates and inflation are making things very difficult for some.
My next guests are here to break down the impacts of this latest hike. Jimmy Jean is the chief economist and strategist at Desjardins. Armin Yalnizyan is an economist and Atkinson Fellow on the future of workers. Thank you to you both. Good to have you here.
Great to be here.
Jimmy, I'd like to start with you. Tiff Macklem said he says the bank expects inflation to ease, but now says it might take until the middle of 2025, so it's moved to later to hit the 2% target, 6 months later than the forecast in April. What does that tell us about whether or not these rate hikes are working?
Well, it tells us that they're working with a significant lag. It also tells us that we're in a pretty unique situation in Canada where we have a lot of immigration. We have very strong demographic expansion of the likes of emerging countries. And that's a significant factor that matters in the inflation calculus, because you have more people in the country that have needs to consume, needs for shelter. And at the same time, we're in a position of having already excess demand in the economy. So as a result, I think the Bank of Canada has taken that information into account, and also the profile of how consumers have been resilient, and just extended that into the future. And that leads to an inflation rate that only settles to 2% by 2025. Now, the question is whether that will necessitate more rate hikes, or alternatively, a rate profile that's kind of maintained at its high levels for longer than what was previously anticipated.
You know, I mean, it's a fascinating dynamic at play, right, where the cost of living is way too high for a lot of people, but then spending and demand is still incredibly high, too high for the bank. And now we have homeowners with mortgages that are getting hammered with these mounting pressures. I mean, is the hike worth the cost in terms of the effect it's having on inflation and the effect it's having on ordinary Canadians?
Right.
Well,
Sorry, Jimmy, that's for Armin. Sorry about that. So we'll come back to you in a sec.
Yeah, actually, opinion is increasingly mixed that this is worth getting from 3 to 2, because that's where we're hovering. We're hovering at the 3% mark. And now you're seeing mainstream economists from previous chief economists of the Bank of England and interesting commentators from the United States basically saying this is not worth it. To go from 3 to 2 is going to cause unnecessary pain. The economy is incredibly resilient. At 1.5%, we are growing just a titch behind the fastest growing large economies, which are Australia and the United States at 1.6%. But that's nothing to write home about. And it's kind of hard not to grow when you add 1 million people to the mix, and as Jimmy was saying. So we've got this really unusual situation where the bank says over and over again, it takes 18 to 24 months for interest rate hikes to kick in. And you mentioned right off the top, David, that we've hiked 10 times. Yeah. Well, we haven't seen the full work through of those 10 hikes yet. And so I was kind of surprised that they raised the rates without waiting to see what is going on, even though it's true that core inflation is kind of moving sideways, stubbornly not continuing to come down, but it's dropped dramatically from last summer. And the jury's out on whether the banks around the world, by raising rates, have had anything to do with that. But inflation has come down everywhere around the world as supply chains have normalized post-pandemic and starting to adjust to the fact that Russia has upended the apple cart for most of the world. Okay, Jimmy, sorry, you wanted to get in on that. You go ahead.
Right. Well, we've been hearing a lot about, whether this is overkill, and the fact that what the Bank of Canada is actually contributing to the problem. And I'm actually pretty amazed, because people are basically discovering how monetary policy actually works. You have to actually trigger some localized inflation through interest rates in order to engineer some generalized disinflation. That's been the case in any prior cycle, and nobody would complain back then, because when the recession would hit, then the unemployment rate started to shoot higher. Deflation was more the subject that was top of mind. The problem right now is that the disinflation elsewhere, particularly on the services side of the economy, that is just slow to be getting underway. 57% of the disinflation we've seen since a year ago has been energy prices, basically, and we have very little control on those globally determined prices. So that's why the Bank of Canada still needs to show that it's on top of things. But I agree with Armin here that going forward, time is going to work in its favor because you have more people that are going to be renewing. So more pain, and that will ultimately demand sacrifices on the household budget front.
Okay, so I mean, I just want to pick up on that. The need for the bank to show that it's still on top of things and sort of look at the track record of the bank over the last couple of years, right? We were told the inflation would be transitory. We were advised by the governor of the Bank of Canada that low interest rates were here for the long term. Then there was the pause, and then now the unpause. I mean, how has the messaging from the bank affected things for ordinary Canadians who might have thought, hey, this is not going to last as long, it's not going to be as painful, and the pain isn't going to be as deep?
Well, to your point, David, it's getting hard to follow the bouncing white ball on the lyrics that we're supposed to be all singing along to. It is very challenging, and central banks all over the world in the last month or so have been really kind of doubling down on the 2% target, and we need to get to that faster, which is kind of weird because they also all say it takes 1.5 to 2 years for existing rate hikes to flow through. But it is a credibility game now. And it's not just credibility of the central banks, it's credibility of the orthodoxy that Jimmy described. You need to have short-term pain to have long-term gain, also long-term game. But it's true that as the central banks raised rates, the number one interest rate sensitive thing is housing costs. So your housing costs are going up. Central bank rate hikes is doing nothing about food, and it's hurting people in major ways. By the most vulnerable people are losing jobs or losing shifts at work. They're losing hours of work. They're losing income when their basic costs like housing and food and gas are continuing to be very high compared to a year ago. And then the costs that we're talking about bringing down are discretionary costs. They're like going out to restaurants, they're travel costs. They're like the trade-off doesn't seem to make any sense to me as a model to follow on when you hike and why you hike.
So Jimmy, you know, on that analysis, I mean, I'm one of the people who renewed their mortgage this week, and it's kicked me pretty firmly in the teeth, right? That pain is there now on something that an expense I have to pay or I lose my house, right? So, I mean, to Armin's point, is this actually the pain that's being inflicted the right way to do it?
Well, kind of, because yes, for sure, it's always worked in this way. It's the housing and it's very interest rate sensitive sectors of the economy that are going to adjust. But we have to admit that the Bank of Canada has been quite alone in this fight on inflation. I mean, we like to sing the virtues of fiscal monetary policy coordination in good times, but that, of course, all goes silent when times get more challenging like now. The reality is that if governments were really trying to help the Bank of Canada get the job done quickly, they would try to come out with some solutions to address their expenditures. In fact, my team has just published a note today that highlights research to the effect that slowing down inflation strictly with the use of interest rates is more penalizing on lower income households than a scenario where governments would couple a net reduction in deficit with increases in transfers to lower income households. Some models are showing that this strategy could in fact produce the soft landing that people are still hoping to happen.
I mean, just as a quick final point, because we've got about 30 seconds left, the next decision from the bank comes, what, September 6th? What's your message to Tiff Macklem as he thinks about that?
Oh, I have no idea. I've been surprised on the downside and the upside recently in the last 6 months. So I'm not going to look into a crystal ball. But to Jimmy's point, it is absolutely true that if you are going to have the type of situation we have right now, where are the governments? Crickets. Like the big story here is housing. People are going hungry because the first thing that eats is your rent. And you were talking, David, about what has happened, the kick in the teeth for your mortgage. Well, you're in about about 10% of all households in the economy that are adjusting their mortgage rates right now. You know who has no room to wiggle are the 41% of households that are renting. Yeah. So yes, we are worried about mortgage holders, but renters are really in dire straits, and governments are the only ones that can fix that pickle.